Hello and welcome. I'm Alex Proimos, Head of Institutional Content and Investment Magazine, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to check out our website, investmentmagazine.com.au, and subscribe for a free email. And with that, please enjoy this week's episode. My guest today is Craig Roodt, Director of Investment and Wealth Advisory at Deloitte Consulting. Craig, welcome.
Hi, Alex. Great to be here.
So I thought today, the best place to kick off with you, given your background, is this current crisis that we have, COVID-19, has totally changed the way that we live, changed the way we travel, how we work in teams, and it obviously has had a very large impact in sort of governance framework and risk management tools that we think about in the world. Can you give us a bit of a context on what are the issues that you're seeing?
Yeah, look, I think the first thing is it just brings home to everybody how rapidly things can change. So if we think back to January, I don't think any of us thought that we would have been subject to an extended lockdown. We wouldn't be able to travel around Australia. Many of us would effectively be, working from home, whether we liked it or not, although for many of us, we've found it's quite suitable. So I think the first thing that it comes home is just how rapidly things can change. And even though there's been a market rebound, certainly comments from people in the market was that in some respects, the sell-off that occurred was some of the fastest sell-offs they've seen for some time. And so I think that's the first thing. Things can change very rapidly. And what does that then mean for a portfolio? It means that in any portfolio, there's a need to be aware of the risk factors. So we've seen, for example, property impacted, retail property impacted in particular. But one of the other things it also highlights is that you can have structural shifts. And it's interesting, another topic that often comes up is climate change and ESG generally. But if you think about climate change, why that is an issue that's gotten onto the radar of regulators, of investors, beyond sort of the general social and environmental issues is, of course, the fact that with something like climate change, you can see over time a readjustment in terms of how people live, where they live, how they travel. And that, of course, will have implications for the value of things like property, as well as the value of different types of companies. It creates opportunities. So clearly we see that the demand for certain things will go up, just the same as we saw in I'll call it the COVID-19 crisis. Demand for broadband went up. Telecom companies have done okay out of it. Anyone who was selling office supplies or electronic equipment has done well through this crisis. And of course, other industries such as hospitality and retail got hit very hard. So I think the very first thing that it shows is things can change very rapidly. And, that apply, if you think about something like liquidity risk, historically, that's been one of the features of liquidity risk. It can be very digital. You go from a situation where you have liquidity to a situation where you don't. So I'd say that's the first lesson, that things can change very rapidly. I think the second thing that comes out of it then is that any sort of risk measurement or risk management approach won't be perfect for the next crisis. And we always hear this. So we hear that regulators look at the last war. We hear that, risk management approaches always look at what happened in the past. When you look at the past to try and give you an idea of what could happen. So people who were doing the stress testing, people who'd done the liquidity stress testing, the liquidity planning, they didn't know they were going to get hit with an early release rule, which has happened to the industry now. But they were better prepared than if they'd done no sort of stress testing. Because one of the things about stress testing and scenario analysis is it makes you think about what can actually happen. And then you can start planning and preparing for that. There's also some short-term things. So clearly, one of the issues that's come up is, again, valuations have become unstable and that can be hard to strike. And there's actual implications there. If you have a portfolio of assets and then it's a unitized portfolio, so investors can enter and exit, do you actually have things that are sufficiently up to date in terms of valuation, even allowing for the uncertainty, so that people can actually trade with a reasonable degree of equity? So I think there's quite a few things that have come out of it. Number one, things can change very rapidly. And number two, more planning, better consideration of possibilities you are always in a better position to deal with whatever may happen, even if it isn't what you planned for.
Well, let's dig into some of the climate change piece, because really a lot of the conversation around sort of climate change, yes, okay, I understand temperature can rise a little bit and it's going to have an impact, but yes, people can move and adjust slowly. You know, one of the biggest concerns around climate change is that it's been very hard to model it from a risk perspective, and it's sort of a bit of a stick your finger in the air and see which way the wind's blowing. But COVID-19, you know, is effectively an ESG risk, right? It's a health risk directly, and it's had a significant impact in the way we live our lives. It's a health crisis that's, you know, had ramifications across the economy and across financial markets. So this almost is like a test run of some other bigger sort of climate risk sort of issue that comes through. But you know, the interesting thing is that you can tell people to model these risks, but we've got a situation where governments alongside central banks are coming back to be the supporting factor of these sort of issues. So, you know, is that what we should expect when there's another sort of climate emergency as well?
I think, look, so I don't want to proclaim that I have some insight into what governments and central banks will do, but I think, look, we would expect, I think it's reasonable to expect, and we've kind of become conditioned to expect this, that when you have a sharp market adjustment, governments are often going to step forward to try and soften that blow. And in the last 10, 15 years, maybe, well, it depends how far back you want to go really, there's been this huge tendency to inject liquidity every time there's a problem. I think what liquidity can do is liquidity can move asset prices, but liquidity can't change a structural shift. It can only possibly drag it out over a longer period. I think one of the things that also happens, though, is if you think about injecting liquidity into the economy, it's very, it has a very broad impact. So if you happen to have something that is, it's not the most efficient way of, say, helping a sector, that's suddenly challenged. And so I think the first thing is, yes, you'll have things like central banks injecting liquidity in response to a crisis. You'll have governments writing checks, assuming they're in a fiscal position to do so, which ours is fortunately at the moment. But that doesn't necessarily mean that the sectors you've invested in will get backed at that point in time. So for example, and I'll give a really extreme example with climate change. So there is an issue, and it's not necessarily just due to climate change, but in some places you have coastal erosion, which has actually meant that in some places, you know, the first row of houses by the beach are becoming unlivable. And now historically, governments and even local governments would try to do things to prevent that occurring. And in many cases, we're seeing around the world now councils going, well, actually, we can't do anything about that. We're going to have to just let the sea take it. Now, sure, you might get some sort of compensation for losing your house. But if, you know, the time comes when your property is going to get resumed by the sea, you might get compensation for it. I don't think you'll get compensation, though, for the sky-high price you bought in at. And so I think the thing is, yes, there will be government support as things adjust, but equally that doesn't necessarily mean there'll be government support for every sector of the economy and for every single thing you've invested in. And I think one of the other things, Alex, is that it's not possible in the long run for the government to completely hold back structural change, which is due to, you know, a broader, you know, a global macroeconomic factor or dare I say an environmental factor, which often ends up becoming an economic factor. It's just very difficult to hold that back forever, you know, and I think that's true of so many other things we've seen. I mean, if the government, for example, wanted to discourage online shopping for some reason, okay, I suppose they could ban it outright, they could tax it more heavily, but there's been a structural shift there for a reason, which means that you're in a bricks and mortar retailer, you're still exposed to that economic structural shift. So there'll be support, but it doesn't change the fact that, you know, every asset owner needs to think about exactly which sectors they're exposed to.
It's interesting you sort of talk about sort of the government coming in to help. There's always a very fine line between sort of helping and being a support, or you know, the other problem that happens in these sort of circumstances is that you end up with moral hazard, and so the real risk management tools and governance sort of seems to fall by the wayside because they do believe, you know, that they will be supported. and that's always an issue. And you talked about sort of the bigger structural changes that are, in the marketplace. There's three big ones being debt, deflation, and demographics that are all looking pretty negative for a lot of the Western world. And yet we've got the superannuation system that is, built on more growth, people paying into the system, and generating retirement incomes ultimately. So I sort of worry about the risk, management tools today, here and now, at the same time the government, providing a backstop to some degree, and then on one degree, then they've done something else, which is create this early access. So can you maybe give sort of how do we frame this?
Yeah, I think it's interesting because I guess there's an element of, as an asset owner, as an asset manager, you can only deal with what is actually within your zone of control, so to speak. And so part of that is having the right risk management to actually think about possibilities and then dealing with those. And so the classic one is, if I'm going to buy regulated assets, so I'm buying, power stations and those sorts of regulated utilities, I do need to think about, as part of my investment decision, the fact that whatever government rules that jurisdiction, they could actually change the rules on me, and I'm actually very dependent on that sort of regulatory, what's the word? Whatever the regulations are at that point. So I carry a lot of regulatory risk.
It's a sovereign risk as well, right? In terms
Absolutely.
of, when you invest internationally, you've got sovereign risk with particular assets. Now is another issue internally in your own domestically that becomes a sovereign risk.
Yeah, absolutely. Now, I think the thing about the early release, though, that's a very hard sort of risk for any super fund to manage, I would say, because that's a fundamental rewrite of the underlying rules of the system. Mm-hmm. And so I think that's almost, this might sound a bit defeatist, but it's almost in the category of an unmanageable risk, because that is the fundamental, that is in the same category, and that's not as extreme, but the government could say, for example, tomorrow, well, you know what, we've decided, given circumstances where the system is and all sorts of reasons, that superannuation will now be optional. That suddenly changes everything. Or we're going to say, well, actually, you know what, people can take out, any person can now take out up to X dollars, and we're going to make this an annual thing you could take out. Now, I'm not saying those are things that are being seriously considered, but those would have implications. It's very hard for anyone to actually prepare for that sort of an eventuality. I think it's about being more generally ready, so being more resilient. So if you build an organization, say, for example, if you build a strategy that can withstand liquidity shocks, then you're better able to withstand what's just occurred. If you build a system, and it's a really difficult thing to do, Alex, but one of the key things for any organization, but certainly any asset owner and any asset manager, to say, is there a fundamental underlying assumption that my system, that my process and my portfolio is based on? Do I have an underlying assumption? So before the GFC, one of the underlying assumptions through the financial markets was, well, you could get liquidity, although you might have to pay for it. Mm-hmm. And that really got challenged. I remember, so I used to be with APRA, and we used to talk with funds about liquidity, and that, many funds really just could not see there was even a potential issue. And, at the time it was a little bit like saying, well, it was like trying to describe a color to a blind person. There was no way they could conceive of it, because there was this mandated inflow at that point in time, and really the whole system was growing at that point in time. And then the GFC was a sharp shock that showed actually this isn't the case. And of course, if we look at the data today, even pre-COVID, a good percentage of superannuation funds were no longer in that member cash flow position that was positive. So, but there are things that are very difficult to, it's really about challenging the underlying assumptions and trying to build something that's actually resilient. So if you deal with as many risks as possible reasonably, you're more likely to be able to withstand those things that just can't actually be foreseen. Because the fact is, there will be things that you cannot foresee. That's just a reality. But it's having a system that's resilient to it and doesn't rely on nothing changing.
I'm curious, because you talk about resilience there that needs to be there, and being prepared for the unknown, right? The true black swan. But how do these companies, these super funds, do that? What are the processes that they need to go through as they think about these challenges? Because it's very easy to sort of discount things as being too far to the left, too far to the right. These can't happen. How do they go about that?
Yeah, I think the first thing is it is looking at the range of possibilities. But I think one of those things is there an underlying assumption? And if this underlying assumption gets snapped, we snap. One of the other things, though, is one exercise that I've seen done is where someone will actually sit down and say, all right, this is the exercise. You've got to look forward, say, 5-10 years, and you've got to work on the assumption that you actually failed. So whatever, whether it's a fund manager, super fund, whatever, okay, this had failed. So tell us what could lead to the failure. So it's actually looking at, it's almost like a reverse stress testing, I'll call it, or a reverse scenario analysis. So you actually look at what can actually bring this undone.
Mm-hmm. So it's like a pre-mortem.
Exactly. Mm-hmm. Yeah, exactly. That's what it is. It's saying what could bring this undone. So rather than saying, oh, well, just what are the probabilities and can this actually say, hang on, what could actually bring this undone? And then actually saying, okay, given that if it happens, it's a severe impact, do we want to think about doing something about it? Now, it might be that you say, well, you know what, to insure ourselves against this is going to cost us 1% a year. Well, that's frankly too expensive. But one of the key things is, and this is the really important thing about governance, because there is a difference between a bad process and a bad outcome. And one of the things is if you have had a bad outcome, you need to be able to show what was the process, what was the chain of decision making. So if in fact you think about something and say, you know what, this is what could bring it undone, we've looked at it, this is what it's actually going to cost us to defray that, well, maybe then we're not going to pursue it for that reason. You then have a position that later, with the benefit of hindsight, is actually quite defensible. And that's one of the things, because when things go wrong, everyone's wise after the event, and very few people realize they're wise after the event. And whether it's something that comes out in the media or whether if you think of the Royal Commission that we had 2 years ago now, that Royal Commission was going back, over things that had happened many years earlier. In many cases, decisions got made and the results only became apparent years later. And so that's why it's really important. If you do that pre-mortem, you look at it, and even if you say, you know what, this is a risk we're not going to do anything about, well, then you want to be able to explain how you looked into it and how you decided it wasn't worth doing anything about. But one of the really important things there is, Alex, is if you have something where this is something that can occur, and it's actually founded not so much on what we're not doing today, but on what we are doing today, then you want to think about, well, hang on, what do we do to mitigate that? Maybe we're going on the right course, but if it creates some fairly severe risks for us, we want to think about what we can do about those.
So you talk a lot about risk. One of the risks that always bothers me, and I'm a little bit biased because I sort of focus on the financial concerns, is that a lot of funds, run their models, they run their risk scenarios using very similar and sometimes the same platforms. We don't need to mention names, but they use the same risk platform to model and do testing. And so my concern is that they're all running with the same approach, but not really truly being, thinking about, well, what happens if there's some sort of a systemic risk that comes with, modeling these failures where we all need to generate liquidity at the same time and we need to sort of balance ourselves out, So it's all good and well having risk frameworks, governance frameworks, but if we're running through the exact same tools and the same scenario tests, I worry, how do you take into consideration that it's not just you, but there's 20 or 30 other funds that will do exactly the same as you at the same time?
And I think that's where, in some respects, and I know this isn't directly answering your question, Alex, but I think in some respects, this highlights why you need a multitude of different measurement tools. And some of them I would say are quite sophisticated, but some of them are relatively crude. And so one of the things is, this is when you look at things like not just, say, running the statistical model and getting the very complex outcome, maybe the VAR number or the CVAR number or something like that, but even looking at the simplistic thing of saying, well, what's my exposure to these different factors? What's my exposure to different industries? Because one of those things then is you can say, okay, because this is the good thing about scenario analysis, is you can actually, so you base scenario analysis not on a mathematical number, you base the scenario analysis on something that occurs. So COVID-19, there's been an impact. It started with a disease, and it was a pandemic disease that's basically spread around the world, and it's hit different economies in different ways, but it was an event. And so I think so in some respects, it's not about I don't think the answer to that sort of modeling risk that you've described is actually more modeling. I think often the answer is falling back onto some other tools, some of those other simple things, which is understanding what's my exposure. So if something happens and shops get shut, how impacted am I? If a particular sector gets shut, how impacted am I? If the 5G network or 4G network got shut down tomorrow, how impacted am I? So it's those sorts of things. And so it's not necessarily, sure, you might, if everybody ran that same sector shutdown scenario, yes, you're right, they're all going to think about it the same way and position their portfolio the same way, maybe. But one of the things is really about saying, well, how exposed am I to these things? And then what happens in those things? So it's actually, I don't think the modeling risk is addressed with more modeling. I think it's addressed then by the fact that you look at different measures and there you're measuring more what's your exposure, what's your factor risk, those types of things.
So it's almost a bit game theory / war games. You're trying to sort of think about, okay, what are other people going to do in this circumstance? And you're almost second guessing and trying to move, dynamically almost through a scenario of what could go wrong.
Potentially, because I think, and in a way, one of the risks you're talking about there is actually the risk of crowded trades.
Mm-hmm, exactly.
And so really that's about then saying, so there the issue isn't necessarily what the PE ratio is. The issue is more, okay, what if I'm just think down at an individual stock level, well, how much of the daily turnover do I hold? Mm-hmm. If I'm going into some sort of a unitized vehicle, do I know how much of that vehicle I am? Am I actually 80% of that unitized vehicle? And so even though, and it might be, say the assets underneath it are illiquid, it may appear to have a reasonably good liquidity promise back to me in terms of how frequently I can get my money. But if it turns out I'm actually most of that fund, can I get out? So it's about doing the due diligence to actually understand who am I invested with. A lot of these things relate to, the alignment. So how am I managing my relations with my fund managers? Mm-hmm. And so a lot of it is about what's the level of transparency? How much do I know? Who am I actually invested alongside? And so these are things that aren't necessarily about the modeling. They're about things like due diligence. They're about what I call almost the human intelligence. What do I actually know about who I'm dealing with? And so, and when it comes back to things like, because if you think a crowded trade, that's actually a liquidity risk. It's not so much based just on the asset, it's based more on the market. And so it is about sort of that market analysis.
Mm-hmm. I'm curious because you talk about sort of, the liquidity problems that are out there and the ability to trade and try and reduce the overcrowding. But we've got this also situation where we're seeing a restructure of the industry where there's this push for more mergers in the space. Isn't that just creating more potential risk across the whole sector?
I guess you'd have to say, like mathematically, you'd have to say yes, because you're going to have fewer asset owners or fewer super funds, each one with more assets. Mm-hmm. You'd have to say on that level, yes. I guess like lots of things play out at multiple levels. You would also, though, each of the super funds, at least in theory, would have a better liquidity risk profile as they get bigger and as they have, larger membership, more diverse membership bases. So I think, for example, one of the things that was highlighted with the COVID-19 thing is, very much liquidity, when you're an asset owner or not so much as an asset owner, but as a super fund, liquidity isn't just what I'm invested in. It's how quickly do I have to give money back to other people. Mm-hmm. And what impacts that and what impacts the flow of contributions. And so we've seen the risk of funds that are exposed primarily to one industry. This isn't a new risk. It's not that, so this isn't a new risk. It's more publicly known now. So I think the first thing you'd say, so to the mergers, yes, presumably each of the funds then has a better liquidity risk profile because it would have a more diverse membership base. Clearly, there's other issues with mergers as well. It's difficult to know in advance that a merger will actually yield benefits for members. If you look at public equity markets, many company mergers don't actually yield benefits for the shareholders. So it's, but I think from a liquidity point of view, yes, mathematically, if you've got fewer super funds, then the liquidity risk does get increased at a system level. But I think that's also offset by the fact that each of the funds are less likely to have a liquidity problem because, again, they'll have a more diverse membership base. So on balance, those two things may balance out. It's hard to know exactly how much, but you are right. At a system level, there's still going to be a greater risk of crowded trades.
Let's take it back to the member, right? In this current sort of environment, there's been an issue where members have got an obligation or an expectation from their fund. We keep talking about member outcomes.
Yes.
But we've had this early access, so
yes.
How do funds, in their thinking, make sure that they maximize member outcomes? Have we now retested basically the promise that we've told people what super is supposed to deliver for them?
In a way. I mean, I think, one of the fundamental tenets of superannuation is that it's a long-term investment. And what we've told people is, well, you can get the money now. And, for a lot of, and of course, it correlates. I mean, it's classic, right? So it'll correlate with size of balance, the security of their employment, and their access to financial advice. And so, the reality is that the lower your income, there's a strong correlation. The lower income, the less likely you are to have secure employment, and the less likely you are to be getting financial advice. And so those three things then work together to increase the likelihood of people taking the money out. I don't know that it's changed the promise, because I think a lot of the people taking the money out aren't really thinking about it in terms of, oh, well, this is different to what I had before. I don't think too many people who are taking the money are complaining. It's certainly going to have an impact over time. One of the things it does do is it does reduce the ability of super funds to invest for the long term, because they actually have to think now. Because one of the issues is it's a little bit like crossing the Rubicon, in the sense that the government did it this time. Now, yes, it is actually a 1 in 100 year event. So from that point of view, you can say very rare, very special circumstance won't get repeated, but also the fact that possibility has happened doesn't mean that there's an increased likelihood in the future. So I think it slightly modifies the promise, and it slightly modifies the ability of funds to sit there and say, yeah, I'm investing for the long term. Because even though we have portability of funds and investment portability, very few members have actually utilized that relative to the size of the system. So that hasn't actually represented an issue for any fund in the past, or generally hasn't. I shouldn't say it never has. So I think it's a slight modification of the member promise. I don't know that it feeds into the thinking of members that way, but I do think it does then impact potentially, the need of funds to think much more about liquidity.
Mm-hmm. Let's keep it on the member conversation. And another member issue that came up over the last sort of couple of months, and I know Investment Magazine's written about it, is sort of the valuation issues in a number of property options, infrastructure, and whether there's equity, member equity fairness around pricing, so that when new money comes in, that it's fair to each person. How do we try and deal with this? I know APRA has some rules around it. But I'm curious if you've got any sort of additional thoughts in terms of, particularly in these quite volatile times when their people are also, got ability to take money out. How do you make sure that it's a fair valuation for all members and that everyone benefits? Yeah,
I think the first thing is that there's no easy or perfect answers. So the very first thing really is that, as part of your valuation governance, as part of your valuation process, if you have these unlisted assets, the first thing is, under what circumstances do you have, I'll call it a trigger for revaluation. Now, that could be a formal revaluation, or it might actually be, look, we're going to have to adjust the value given the observable inputs that we have, but we will need to adjust the value and do that, as much as possible in a real-time setting. To take account of the fact that members can transact on the other side. So the first thing is, okay, are we actually checking the valuations, and are we actually looking at what's occurring? And one of the really important things is super funds do need to be able to explain the economic logic of the valuations they hold. So, so in the past, APRA has said, for example, that they don't expect directors of super funds to be valuers. That's not reasonable. But, and to give a crude example, if every asset in the world has gone down 20%, but you hold a portfolio of unlisted property which hasn't changed in value, you need to be able to explain that. So it's really about that, having the governance process to actually look at When should we be adjusting these things? The other key thing, of course, is how often can people actually transact in the particular fund or vehicle? And so you want to keep those two as linked as possible. So it comes down to, what are the thresholds for revaluing? What are the trigger events for revaluing? And then how do you actually go about doing it? And how much are you looking at the observable inputs? If you actually find yourself in a situation, and there are rules around this, where if it's severe enough, you actually have to look then at suspending pricing and things like that. That's not an easy situation to actually work through. Can be done. But the key really is having that framework, so you can actually say, hang on, let's look at what's going on here and work out what we're doing. And again, the key thing is being as up to date as possible with the values you put through. And so the other key thing then is, how much does this actually impact your price? So if, for example, 1% of your assets are unlisted, there's probably no reason to even be, your unit prices can still keep rolling. If in fact 40% of your fund or 50% of your fund is unlisted assets, then you have a much bigger and much more difficult problem. But the key thing is, what are the trigger events? What extra advice do you need at that point in time? And are you, how are you able to adjust the valuations to deal with this? But there are no easy answers.
Is one of the answers maybe to move away from daily liquidity to maybe weekly liquidity or something like that? Because we've got a lot of assets that don't value until the end of the quarter or end of 6 months, but we still offer daily liquidity.
Yeah. I think, look, as a general principle, you want to line up your frequency with which your members can transact with the frequency with which you can revalue things, or at least revalue them often enough. So reducing that frequency would be good if you could practically do it. The reality is that with the portability rules, especially in the MySuper space, you've actually got to be prepared to pay reasonably quickly, which means you've got to have reasonably up-to-date transaction prices that you will use. So to the extent that you can reduce that frequency, that would help. But the extent to which you can do that is sometimes limited.
Now, we can't finish a conversation without talking about some of the other regulations that are out there, right? As a former regulator, I've got to touch on what's been going on with RG97, the DDO, the design and distribution obligations. What's happening in that space? Yeah,
look, with I think the first thing is that member outcomes, there's no delay. A lot of other requirements, there's been some delay. And especially the design and distribution obligations in particular have been pushed back for 6 months. I think the key is that while these things have been delayed, they haven't been deleted. And so the reality is, if you think about design and distribution obligations, the objective or the need to have a target market determination, to then actually have the necessary systems and the information flows to actually know, who's buying your product, and do the people who are buying the product fit with your target market, those sorts of things, then to be able to do sort of value in use assessments, all of those types of things, you are still going to have to do that. I shouldn't say you, but any super fund, any investment manager distributing products out there is still going to need to be able to meet those obligations. They're just delayed. And so I think the thing is, yes, due to COVID-19, there's been a delay on some of these obligations, but equally anyone who's in a position to start preparing for them, a longer lead time is always better than a shorter lead time, because whenever you look at some new rule that takes effect at a particular date, often there is a need for whether it's system work or specialist advice or anything like that. And those resources tend to become much more pressured as you get closer to the actual go live date. And so, so DDO, it's been delayed for 6 months. RG97, that's still proceeding. Again, RG97, it calls for very detailed analysis of your costs and understanding your downstream costs. So with all of these things, there's still a lot of work to do. I think it's still part of that reaction of, wanting to try and get a focus back onto, whether it's better outcomes for members or trying to ensure that members are only winding up in the right types of products, all of those sorts of things. Or, of course, it's interesting. So if you think of, I'll say member outcomes, DDO and RG97. So member outcomes is about saying, well, you've got products, you've got to look at what you're actually getting for the members. You actually have to have a framework that says, what are you trying to achieve? And then work towards that. And then if you're not doing that, apply the management feedback loop to actually fix it. Design and distribution obligations. So then if I just look at the commonality there, you're actually saying, well, as a product manufacturer, you're responsible for understanding who this product is actually suitable for. So of course, it only applies where personal financial advice isn't provided. But if there's no advice in your distribution, then you have to work out who this is suitable for. So again, seeing to it that you are going to provide or market this product to the right people. And if you find out systematically that people who are not in your target market are buying this product, then you need to start thinking about you need to start addressing that. RG97 is about then empowering members again, or consumers again, by giving them more information, very detailed information. Some might say, well, how understandable is that information? But about giving them more information so that they can, compare, not so much performance, but that they can actually compare the total costs that are effectively being consumed in the fees they pay when they buy products, and how much of the performance will get eaten up by fees, those types of things. And so again, what you have is you have a set of rules that are both trying to empower the consumer, but are also trying to ensure that the producers are aiming this at the right people and then actually building it in the right way for them. And I think that general trend will continue. Obviously, we will see in, say, 3-4 years' time how well this collective set of rules have actually assisted. And I think it's still part of the trend that we're still working our way through.
All right, Craig, that's been a fantastic conversation. Thank you very much for your time today.
Oh, no, thank you for your time, Alex.
Thank you for joining us. All views expressed on this podcast are subject to change and do not necessarily reflect the views of Conexus Financial. This podcast is for educational purposes only and should not be relied upon as investment advice.